I think it's fair to say that Cathie Wood is a little bit of a contrarian investor. Now, she had an absolutely incredible 2020. As the COVID pandemic raged on, she bet pretty firmly in the vein of tech stocks like DocuSign, Peloton, and Tesla, and she made herself an awful lot of money along with her investors. But then came 2021, and frankly, she had a less than stellar performance as the market started to rotate away from the companies that she made her money on and they moved towards more value stocks. And then, as 2022 has slowly ticked along, Cathie Wood has had an absolutely disastrous year, seeing most of her money disappear, seeing her investors leave her fund in droves as she returns negative percentages week after week after week. Now, the narrative that she's pushed for almost 3 years now at this point is that inflation isn't a real threat, that it practically isn't even a real thing, and that deflation is the real threat because technology is just so ridiculously innovative and so monumentally transforming that nothing else will matter in the long term. The only aspect that will really determine asset prices into the future is how fast productivity increases as we enter an ever more digitally enhanced age. Now, unfortunately for Cathie, so far she has been wrong across the board. She was wrong about inflation never peaking up in the first place. She was wrong about it being transitory, and she's been wrong about it peaking month after month as well. The reality is, though, that she was right on a certain few things in the past, and it's entirely possible that she's right in the future as well, which is why I personally think it's always worthwhile at least considering what she has to say, looking over her arguments and the data that she presents to find out what's likely to happen next. Now, as she so often does, she came out with about a 15-minute long YouTube video explaining her point of view on the markets, on asset prices, and where she thinks everything's going out into the future as well. Now, it was pretty crazy interesting though. There's an awful lot to be said. There's an awful lot to hear. And as usual, I've taken the liberty of going through that video, taking out the best bits, the important bits, which I'm going to show to you now before I add some context and before I finally explain why I actually agree with her on quite a few different points here, which is very strange for me to be saying, but ultimately, at the end of the day, I do disagree with one major thesis that she has about the future.
I did a tweet thread last weekend and basically concluding that the Fed right now is much more worried about its own legacy than it is about the economy. It is so afraid that it has let the inflation genie out of the bottle and that it won't be able to get it back. That it is in unison, basically going out there and saying, we are going to tighten. We have an unconditional commitment to 2% inflation. Well, I'm going to be sharing with you a lot of indicators that will um, suggest that using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a sevenfold increase. We've never seen that before. Now, I know a lot of critics are suggesting, oh, what are you talking about? From such a low level. You can't make a comparison to the early 80s when interest rates went from 10, Fed funds rate went from 10 to 20%, which was only a twofold increase. You just can't make that comparison. Well, yes, I can. I can make that comparison up fivefold very quickly. And I think the Fed has panicked, and it's causing the economy a lot of problems. As I mentioned before, though, it's becoming obvious now, and I do believe they will change their tune with a few more reports. Another interesting variable out there, but it was the sentiment and this idea that if sentiment is that low, then I'm going to come back to another concept that we've talked about in the past, and it's controversial, but it's the velocity of money. From my experience, the velocity of money is influenced by a few variables, one of which is sentiment. If people are scared, as they were out of 08, 09, if they're and they're more scared now. If people are scared, they spend less. Now we haven't seen that yet until May. May we had a negative consumption number outright. It was minus 0.4. We'll get into this in a minute when I talk about economic indicators. And what that tells us is, yes, the consumer is now pulling back and not betting that in prices and interest rates are going up and I have to beat them and buy whatever I want now, whether it's a home or a durable good. That behavior, if it existed, is stopping, and the velocity of money, which is the rate at which money turns over as the consumer chases in an inflationary environment, it turns over faster. As the consumer recoils, it turns over slower. Well, that's very interesting because the estimate for June's money growth is based on what we know about demand deposits in the banking system, is about 5%. If the velocity of money is slowing, that means that GDP growth will be less than money growth. And if money growth turns negative, as some people think it will on a year-over-year basis, it already has year to date. It's down from its peak. But if it were to turn negative on a year-over-year basis, then the GDP growth falling further below that would be quite the recession. So we're very focused on confidence and this notion that deflation is actually going to cause the opposite. If you expect prices and interest rates to go down, then you'll hold off buying. And if you're scared, you won't buy anything to begin with.
So Cathie Wood is still bullish on tech stocks. We know that now, and we've known it for months now. ARK and her investments there are still super invested in tech companies. She's continued to buy companies like DocuSign, Teladoc, Tesla, and a number of other high growth companies that she's sure their productivity, their increases that they provide to the world will just be so monumental that they can't be ignored. Her argument is pretty simple, and actually it does make sense. It's that innovation is going to be so catastrophically disruptive that people's productivity growth will be so ridiculously high that internet companies are going to be so ridiculously efficient that nothing else will matter, that these companies will grow and grow and grow their revenues, their sales, their profits, and so into the future their asset prices will grow on the whole as well. Now that is a very fair assumption to make, and it does make a lot of sense for the most part, and especially when you consider companies like Tesla who are truly innovating industries and changing the way the world is. The major problem with this is that the Federal Reserve and its tightening, the monetary tightening that we're seeing actually all over the world, is really bad for innovation and bad for growth, and that's the problem that Cathie's fund is facing right at this moment. Nonetheless, though, Cathie is as sure on her strategy as she has ever been, and her argument here is that actually a recession has already started, that it's already present in the US and in a number of other Western countries as well, and as a result of this recession, consumer spending will absolutely collapse, people's demand for everyday products will absolutely drop off a cliff, and as a result of that, prices will fall as well because they're in an ever constant balance between supply and demand. As prices drop, inflation will obviously drop as well, and actually into the future, Cathie expects this to be so severe, so drastic and so changing that this turns into deflation where we see prices dropping week after week instead of rising. Now, one thing that Cathie also sees happening is the Fed changing its tune. Right now, it is hell-bent on reducing inflation. It's certain that actually that's the main mandate it has, and so it's hiking interest rates, and it's supposedly selling off its balance sheet as well to try and finally tame these rising prices. Cathie Wood, though, is adamant that as this recession kicks off, as we finally start to see the data showing that the economy is in absolute turmoil, that the Federal Reserve will change its tune, that it will start cutting its interest rates instead, and it will turn on the money printer once more, buying up assets willy-nilly, inflating markets all over the place. Now, this is actually quite a mainstream view for the most part at the moment. It's what a lot of markets are pricing in recently, and it's why, as we got new recession fears over the last few days, the Nasdaq and its tech stocks actually rose while every other equity market fell for the most part. Now, I personally actually agree with her on most of what she claims there as well. I do see the Fed as a weak institution that isn't really focused on its goals as it should be. It's very concerned with its credibility into the future, and so it's trying to tame inflation now. But as a recession kicks in, I don't think it's going to hold on to that same vigor, and I do think it's very likely that Jerome Powell either leaves office or he just changes his opinion and he resorts back to quantitative easing and 0% interest rates. This does, though, bring me on to the point where I actually disagree with Cathie, and this is the idea that Cathie put forward where this inflation is going to be so destroyed by this recession and by the Fed's tightening that it's going to be replaced with the polar opposite and deflation when prices start to drop. Now, she has been adamant that deflation is the real threat for over 2 years now, and so far, nothing that she's claimed was going to happen has come true. She's been proven wrong so far, time after time, but there is a chance she was just early here. The problem with her argument, in my opinion, is that once inflation falls and the recession hits, the Federal Reserve will turn its money printer back on. It will start buying up mortgage-backed securities again. It will start buying up other types of bonds as well, and interest rates will drop back down to 0% to try and stimulate the economy, to get people moving, to get people spending, to get businesses investing back into their markets. And we'll also see the exact same thing on the fiscal side of the economy. The Democrats have time and time spoken about fiscal stimulus, about spending bills to get money in people's pockets because they believe it's a surefire way to help grow the economy. And if a recession kicks off, you can best believe that Biden and the rest of the Democrat institution will waste no time putting together another multi-trillion-dollar spending bill, adamant in the belief that it will spur the economy on and turn a recession back into a booming market. Now, when it comes to this world of quantitative easing or 0% rates and governments which literally throw money at its citizens, hoping that they will stimulate demand and turn an economy around, we've seen just how effective this is. We've seen just how influential it is. And in particular, we've seen the absolutely monumental effect it has on inflation. Now, for a while, there were many naysayers to this idea. Modern monetary theorists who claimed that actually there was a good chance that government spending willy-nilly and quantitative easing wouldn't lead to inflation because the money gets caught up in other systems, but that has now well and truly been proven wrong, and that's been the case for the best part of the last year as we've seen inflation balloon up to ridiculous levels that we thought were nigh on impossible. If Cathie is right that the Fed crashes the economy and we turn into a full-blown rout, well, the likelihood is, in my opinion, that actually the money printing will be more than enough to stave off any kind of deflationary forces, and we won't revert back into a weird deflationary economy. The deflation argument that Cathie Wood is putting forward relies on one thing that I just don't think is very likely. It relies on the government behaving in a way that it has never behaved in the past in history. It relies on a conservative government that doesn't want to stimulate an economy, that wants to let free market forces take force and allow deflation to destroy an economy. Frankly, I think that's an incredibly unlikely outcome, and it goes against all historical precedent that we have. The argument that I believe in and that I think is likely going to come to fruition relies on the idea that the government is probably going to react in the same way that it reacted in the past, in 2008, post the housing market crash, in 2017 and 2018, following the taper tantrum, and in 2020 and onwards as well, as we had COVID lockdowns and the recession that was induced from there. I think it's far more likely that a government continues to act in a selfish, foolish manner that will in the long run cause more pain and more harm, but that's just something that governments do, and we've seen it firsthand time and time again. Now, all that being said, I do find it very strange to actually agree with Cathie Wood on a lot of things that she said for once, and I am curious as to what you all have to say. If you're like me and you think she's right on some parts there, but she's wrong on the deflation call, or if you're on the other end of the spectrum and you think she is going to end up proven right in the end and come back to her superstar fandom. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to iTrust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join iTrust Capital. Thank you all for watching. Stay stoic. Until next time.